So, there are at least 7 different types of mortgages you can get right now, but your bank is only going to show you 1 or 2 of them that makes them the most money. After approving over $40 million in financing and closing more than 200 loans for everyone from first-time home buyers to self-employed business owners who got told no by every other lender, I can tell you that most people are either in the wrong loan or paying way more than they should. And that's just because nobody broke down the options for them. So today, I'm gonna walk you through every single type of mortgage and who each one is actually designed for. And by the end of this, you'll know exactly which one matches your income type, what down payment, and what you actually need, and whether the loan you're in right now is costing you hundreds a month more than it actually should be. Let's get into it. Now, the first one is what most people think of when they hear the word mortgage, and that's a conventional loan. This is a standard. You go to a lender, you qualify based on your W-2 income, your credit score, and your debt-to-income ratio. And the loan is backed by the federal government through Fannie Mae and Freddie Mac. Right now, rates are sitting around 6.2 to 6.3% for a 30-year fixed rate loan, which is down from almost 6.7% a year ago. The minimum down payment can be as low as 3 to 5% for first-time home buyers. But there's something nobody tells you about putting down less than 20%. You're going to pay something called private mortgage insurance, or PMI, every single month until you hit that 80% loan to value mark. On a $500,000 loan, that PMI runs you anywhere from $200 to $400 a month, depending on your credit score. And that money does not go towards your equity, towards your principal. It's just gone. So you get to 20% down, you eliminate that cost entirely, which over the life of the loan can save you tens of thousands of dollars. Now, the other thing you need to know about conventional is the conforming loan limit. For 2026, that cap is $832,750 for a single family home in most of the country, and that includes Miami. The median single family home in Miami-Dade right now is sitting at just give or take $700,000. So the second you're looking at anything in Brickell, Coral Gables, Miami Beach, Coconut Grove, you're already pushing past that conforming loan limit. And once you go above it, conventional either requires a jumbo loan with stricter terms and a bigger down payment, or you need to look at a completely different product. Which brings me to the next type, FHA. FHA is a government-backed loan program designed specifically to get people into their first home when they haven't saved a massive down payment or their credit isn't perfect. You can get in with as little as 3.5% down if your credit score is 580 or above. On a $400,000 home, that's $14,000 down instead of $80,000 like in conventional. For a lot of first-time home buyers, that's the difference between buying this year and waiting another 3 years to save. But here's a catch that nobody talks about. FHA charges mortgage insurance for the life of the loan. Doesn't matter if you build equity like conventional, it's for the entire life of the loan. There's also an upfront mortgage insurance premium of 1.75% of the loan amount that gets added to closing. So on a $400K loan, that's like $7,000 backed into your principal balance. And then on top of that, you're paying $183 a month in monthly mortgage insurance. That's roughly $2,200 a year in insurance on top of your actual mortgage payment every single year until you refinance out of it. So the smart play with FHA is to use it as a bridge, not a destination. You get in with FHA, you build equity through your payments and natural appreciation, you get your credit score above 620, and once you save 20% in equity in the home, you refinance it to a conventional loan. That will drop the mortgage insurance entirely, and it will usually get you a better rate, of course, depending on the market. Now, most people can do this within 3 to 5 years, depending on the market. FHA was never meant to be a forever loan. It's a tool to get you into the game. Now, everything I've covered so far requires traditional income verification, meaning W-2s and tax returns, and this is where things shift, because for self-employed people, business owners, freelancers, and anyone who income on paper doesn't match what they actually bring in, those traditional loans are a dead end. And that brings us to my favorite, bank statement loans, which are one of the most underused tools in the mortgage world because most lenders don't offer them and borrowers don't even know they exist. So here's how that works. Instead of looking at your tax returns, the lender reviews 12 months of your personal or business bank statements. They calculate your income based on your gross deposits. No tax returns or W-2s needed. For personal accounts, they count your deposits at face value, meaning they use 100% of the deposits in your personal account. But for business account, they apply what's called an expense factor. It's usually 50% by default. So if you're depositing $30,000 a month into your business bank account, the lender will only count $15,000 as your qualifying monthly income because they assume half of it goes to expenses. But most people don't know that if you have your accountant or CPA write a letter showing that your real expenses are lower, say 30% operating expense ratio instead of 50%, that same $30,000 in deposits now becomes $21,000 a month in qualifying income, which gives you way more home. That's $6,000 difference in what you qualify for just from having your accountant write a letter. And this is why it matters. A business owner brings in, let's say, $300,000 a year through their accounts, but on their tax returns, they only show $60,000 because they write off everything they can, which is a smart move from a tax perspective. But when they go to a bank and apply for a conventional loan, the bank looks at the $60K on the tax return and says, you don't qualify. Meanwhile, their bank statements can show exactly what they can afford. That's the gap a bank statement loan is able to fill in. Now, the minimum down payment is 10% for a primary residence with 680 credit score, and then 15 to 20% for investment properties. And the interest rates are closer to conventional than most people think. A well-qualified borrower putting 20% down with strong credit is looking at maybe 6.75 to 7.25 right now, which is barely above what a conventional loan costs. Now, these are what's called non-QM loans, meaning they're not backed by the federal government, but they're legitimate regulated mortgage products funded by real banks. Chase, Wells Fargo, and Bank of America, they don't offer these because non-QM loans cannot be sold to Freddie Mac and Fannie Mae, and big banks only want to deal with loans they can bundle and sell off. The only way to access bank statement loans is through a mortgage broker who works with wholesale non-QM lenders. And if someone told you that you can't qualify for a mortgage because you're self-employed, well, there's a good chance they just didn't have access to this product. Now, there's another option that goes even further than bank statements, and that's P&L loan, which stands for profit and loss. Instead of 12 months of bank statements, the borrower has their accountant prepare a profit and loss statement for the last 12 months. And that document becomes the income verification. You don't need bank statements or tax returns, just a certified P&L showing what the business made and what it spent. And here's an example of when you'd use this instead of a bank statement loan. Sometimes borrowers' bank statements are very messy. Maybe they have large foreign deposits that raise red flags. Maybe they receive income in cash, or maybe they have money coming in from multiple accounts across different banks. The P&L bypasses all of that because the lender is looking at the accountant's verification and what the business earned, not the raw deposit history. So for example, I had a client that wanted to refinance her condo in Miami. Because her income came from various sources, some being out of the country, it was difficult for any other lender to prove what she was actually making. Now, this borrower in particular had several different business accounts. So they had businesses in Dominican Republic, businesses in Costa Rica. So all this income that was flowing from these other countries, it was an organized mess for her, but not for the lender. So what we did was, instead of showing bank statements from every single business where we would have had to add up pretty much everything to get her to qualify for this refinance, we were able to have her CPA prepare a profit and loss of the income that she's made over the last 12 months. With that, we were able to bunch up everything together and complete the refinance without having to show tax returns, W-2s, or even her bank statements, so that we did not have to get into explaining why and where all these funds came from. And one thing that most people don't know is the accountant does not need to be a CPA. A licensed tax preparer or an IRS enrolled agent with a PTIN can prepare the P&L, which makes it accessible for borrowers who work with smaller firms. Rates are in the same range in bank statement loans. Sometimes they're even slightly better because lenders view the CPA prepared financials as more credible documentation. And real quick, if you're self-employed or you have non-traditional income and you've been told that you don't qualify for a mortgage, I'll leave a link in the description below where you can book a free consultation with my team. We'll look at your specific situation and tell you exactly which of these loan types fit and what path to approval looks like. Now, everything I've covered so far has been for people buying or refinancing a home that they're going to live in. But if you're an investor or you're thinking about getting into real estate investing, the next two are the ones that change the game entirely. DSCR loans. DSCR stands for Debt Service Coverage Ratio, and this is the loan type that completely changed how investors buy property. The entire qualification is based on the property's rental income. So you don't need a W-2, tax returns, bank statements, or any personal income verification at all. If the rent covers the mortgage, you qualify. And right now, DSCR rates are sitting between 6.1 and 6.6%. So for a 30-year fixed rate loan, which is barely above conventional, it's pretty good. So let me break down how the ratio actually works, because once you understand this, it clicks. If the monthly rent on a property is $2,500 and the total mortgage payment, including principal, interest, taxes, insurance, and HOA, comes to, let's say, $2,000, the DSCR ratio is 1.25. That means the property brings in 25% more than it costs to carry. Most lenders want at least 1, which just means the rent covers the payment. Some will even go below 1 with a larger down payment if you have strong credit. But here's why the DSCR is a game changer for scaling. Conventional loans cap you at 10 finance properties, and every single loan sits on your personal debt to income ratio, which means each property you buy makes it harder to qualify for the next one. DSCR has no limit. Investors routinely carry 15, 20, and even 30 plus DSCR loans at the same time, because each property qualifies on its own income, not yours. And if you hold the loan through an LLC, it generally doesn't report to your personal credit, which means your personal DTI stays clean for future purchases. We used a DSCR loan for an example with an Argentine investor who had no income that he can verify in the US. Although operating out of the US and making money from businesses, because there were no tax returns, there were no stable bank statements or deposits, we had to find an alternative solution for this investor to be able to continue to buy properties and create a portfolio in the US. This investor had recently gotten denied by several local banks in Miami before getting to us. We went over the investor's situation and realized that all of the income that he was able to provide was out of the country. The banks won't allow unless it's a foreign income loan. An example we recently had where DSCR loan was a perfect fit was a client that had just gotten denied from a local bank trying to do a conventional loan. This investor had properties in India where all of the asset statements, the taxes, and everything else, lease agreements, were all in a different language. Because conventional loans, Fannie Mae and Freddie Mac, require for documents to be translated into English, the investor was unable to qualify for a conventional loan. When the investor got recommended to us, we immediately saw the need for a DSCR loan. We were able to close the investor in just 2 weeks while they were buying a new construction condo here in Miami and offer even the same rate that they were getting with conventional. The only difference is that the loan had a prepayment penalty, contrary to conventional where it does not. But since they're long-term investors and they planned on keeping the property for more than 5 years, it was a perfect fit for someone who needed a DSCR loan. DSCR is also one of the only mortgage products available to foreign nationals investing in US real estate. They typically need 25 to 30% down, but no US income is required at all. So if you're serious about building a real estate portfolio, DSCR is the tool that removes the ceiling, because you're not limited to how much you make, how much you have, you're limited by how good the deals are that you find. Now, sometimes investors need to move fast, and that's where hard money and bridge loans come in. Hard money is short-term, asset-based financing used for deals that need to close quickly or for properties that don't qualify for permanent financing yet, like fix and flips, distressed properties, or auction deals. The lender is primarily looking at property value, not your income or credit, and these loans can close in 7 to 14 days compared to 30 to 45 for conventional. But I want to be honest about the cost, because hard money is expensive. Interest rates run from 9 to 14%. Origination fees are 2 to 3 points on top of that, and terms are usually 6 to 18 months with interest-only payments and a balloon at the end. meaning you got to pay it all back. And a $300,000 loan at 11%, you're paying $2,750, give or take, a month interest alone. This is not a loan you hold long term. It's a tool to get in, do the work, and get out. And the biggest mistake investors make with hard money is getting into a deal without a clear exit strategy. The smart play is to have your permanent financing already lined up before you even close on the hard money, whether that's a conventional, a bank statement, or a DSCR loan waiting on the other side. That's where having the right mortgage broker matters, because you need someone who can see the whole board, not just the first move. And that brings me to the last type, which ties everything together, and that's cash out refinance. A cash out refi isn't a new purchase loan. It's for people who already own a home or an investment property and want to pull out the equity they've built. The lender replaces your existing mortgage with a new, larger one, and the difference goes to you as cash. Most lenders allow up to 80% loan to value on a primary residence and 70 to 75% loan to value on investment properties. And this is how experienced investors use the equity they've already built as fuel for the next deal. So, say you're an investor. You buy a distressed property for $250,000. You put $50,000 into renovations. So total invested is $300,000. After the rehab, the property appraises at $400,000 and rents for $2,800 a month. The cash out refi at 75% gives this investor $300,000 loan, which means they get their entire $300,000 investment back in cash. Now they own a $400,000 asset with $100,000 in equity. The rent covers a mortgage, and they have all their capital back to do it again. That's how investors go from one property to 5 without making more money. They just keep recycling the same capper. And the best part about a cash out refi is you can do it using a conventional, a bank statement, a P&L, a DSCR, or depending on the property and your situation. So everything I just covered, all 7 of these loan types, they all connect. Now, here's what I want you to take away from this. The right loan for you depends entirely on your income, structure, your goals, and most importantly, where you're trying to go. And the problem is most lenders only know 1 or 2 of these products, so they'll try to fit you into whatever they can offer, even if it's not the best option for your situation. That's the difference between working with someone who knows the full landscape and someone who's just pushing what's on their shelf. So if you want to find out exactly which loan type fits you, I left a link in the description where you can book a free consultation with my team. We'll look at your income, your goals, your timeline, and map out exactly which path makes the most sense so you're not overpaying or getting stuck in a loan that doesn't fit. So thanks for watching, and I'll see you on the next one.